The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech, and today we are going to take a deeper dive into DeepSeek, some of its implications with regard to the stock market. If you like the content that we provide today, we'd appreciate it if you would subscribe to the podcast on YouTube. And you probably have friends, family, or coworkers who would be interested in the same material. Share the link with them. We'd appreciate your doing so. You also can go to our website and register for next month's stock market update. The shortcut is iriradio.com. So with that, I'm going to get started by taking me off the screen and giving you maximum space. So here we go. When we deal with DeepSeek, it was kind of a shock to the market over a recent weekend as we ended January and started February. And like all other Chinese models, DeepSeek is a self-censoring topic. It's something that's actually been known, which I'm going to cover in a couple of minutes. It's not something brand new, which the market seemed to think it was. DeepSeek self-censors on topics that are deemed sensitive in China, which is pretty similar to anything else that China publishes and makes available to outside the country. And while it deeply censors inside the country, it deflects queries about the 1989 Tiananmen Square protest or geopolitically fraught questions such as the possibility of China invading Taiwan. In other tests, the DeepSeek bot is capable of giving detailed responses about political figures like Indian Prime Minister Modi, but declines to do so about Chinese President Xi Jinping. Seems strange that has that kind of selectivity if in fact it is an effective AI tool. It did, however, have impact on the market. So on what I show here on this chart is that on the drop from the high of the market, the previous all-time high, to Monday's morning open, it dropped 6.3%. On the NASDAQ, tech stocks actually dropped further than that, as much as 20%, and NVIDIA about 17%. The net result is there was a great deal of panic among investors and financial advisors trying to figure out what on earth is going on. And so if you didn't have to go very far in the press to figure out or to find commentary that said, this is what we think, because the assumption was nobody knew. It was a guess. Quickly looking through headlines, news feeds, and we ended up with, I have a collection here of different comments from various analysts and brokerage firms. This DeepSeek was actually started by a Chinese hedge fund that acquired processing units prior to import restrictions. So they really did have some possibility of using high-speed and advanced technology. But despite Monday's technology drop, the broad market really didn't sell off very much. But it was a wake-up call for U.S. tech companies. DeepSeek, as it's called, stirred Chinese companies to accelerate their AI use. For instance, Alibaba announced on the first day of their new Lunar New Year, which would be like making an important announcement on our January 1st, when people are paying attention to football instead of business. Alibaba announced their version of AI implementation called Quinn version 2.5. So they'd already been working on this. Basically, it tells us that competition for the application of AI, or to be known as the primary innovator, is quite fierce, both here and abroad. The issue with DeepSeek is they claimed to have done this with substantially less cost and substantially less time and substantially less need for deep power sources. And if all of those were true, that would make it a serious innovation, probably causing problems for US AI companies, but opening the door for quicker and broader application in all the other sectors of the market. We just simply don't know. So the real question is, yeah, what's up, Doc? This wasn't brand new. I mentioned that just a minute ago. What we do know is that there was an article in Forbes back on November 29th saying that DeepSeek has a chain of thought, and it looks like maybe it might work actually. And there was another article that preceded that on TechCrunch. The AI backed is backed by a quant hedge fund. Basically, has a rival model to OpenAI's initial application. So what happened over the weekend at the end of January should not have been a surprise, but apparently these two prior articles had not been sufficient to cause concern among the technology industry. And with the advent of that over the weekend, it created a great deal of intrigue. What's going on here? And that opens the door for not only professionals, but non-professionals who are tech geeks, basically, to take a look at what is happening. And one of those was done as a study by NewsGuard, which is a global leader in information reliability, and it revealed issues with DeepSeek's answers. The research showed that DeepSeek's chatbot only provided accurate responses to news and information prompts 17% of the time. And in 30% of the cases, it repeated false claims. On top of that, 52% of the time, it gave, quote, vague or unhelpful responses, end quote, to news-related questions. So NewsGuard rates DeepSeek's chatbot with a fail rate of 83%. So if you're doing a deep search on the web, the internet globally, are you going to be satisfied with a 17% accuracy rate, or will you quickly abandon the product? When you look at that compared to the US developed competitors, which average around a 62% accuracy. And the assumption is when people are using AI, it's 100% accurate. There's no doubt about it. And that, in fact, is not the case. A spokesman from DA Davidson in an interview with Reuters told them, quote, the importance of the DeepSeek breakthrough is not in answering news-related questions accurately. It is, in fact, that it can answer any question at 1/30th of the cost of comparable AI models, end quote. The question we must answer is, DeepSeek, Vogon in the Hitchhiker's Guide to the Galaxy, seeking to destroy the Earth, or at least our tech dominance? That question remains unresolved, but as the week progressed, it seemed increasingly that it was just another round of Chinese stealing intellectual property. However, it created a great deal of excitement with the announcement. There are concerns that the information from China is exaggerated. DeepSeek's latest AI model rose to the top of Apple's store charts over the weekend, presenting a visible challenge to costlier models like OpenAI and raising questions over the hundreds of billions in planned spending on the technology coming from companies like Meta, Microsoft, and Alphabet. NVIDIA, whose shares had soared ninefold in the past 2 years, was off 17%. But as for the NASDAQ, it wasn't such a big deal. So basically what we had here was from the prior Friday's close, we had this drop that occurred on overnight over the weekend with Monday, and then a fairly significant amount of rebounding during the week with the closing down on Friday. But when we look at this, what we really see is that this isn't a trading channel. So the news was significant, forced us below the 50 uh, daily moving average, and it basically bounced up. And we've been here before. Back in August, we were deeply below the 50. September, we tested it again. So we've had two tests here in this last month. But when we consider this as a trading range and there's been a lot of extended valuation, a lot of speculation, this really is not a major surprise for people who are paying attention to the market and not just simply speculating on moves. So the sell-off did sell us that the exceptionalism that we are applying to AI companies is is perhaps not very strongly rooted. That we do need to be a little more concerned about valuation, profitability, where companies are going, what the CEOs are really telling us about what's happening with their application plans. And we see that in Microsoft, where it closed this Friday still down, even more from the prior week. The basic problem with Microsoft is that they've committed massive amounts of money to data centers. But if the DeepSeek is truly more efficient, then all these data centers are not going to be overwhelmed with processing, and they're not going to require the massive amounts of money that has been committed or planned on developing additional power sources, building out electric utility facilities. But as we've repeatedly seen over the past few years, investors are more than willing to ignore valuations as long as there's a promise of long-term revenue and earnings growth that's still intact. Once that goes away, however, the justification for higher multiples goes away too. Now, the promise from Google seems to still be intact. So the market has responded with Google saying whatever they're doing makes more sense than what we think Microsoft is doing. Meta has also received the confidence of investors as it continued to move higher through this recent weekend debacle. And as Mr. Zuckerberg says, uh, Meta is going to be the AI application, the search engine of dominance, that they expect to have a substantial increase in users because of the efficiency of their particular product brought into the marketplace, and they have a very broad global user base. And then there's Apple. Apple started to recover, but they'd been in a downtrend all month. They topped out in December. They had a morning run up, which then failed. The net result here is that when you take a look at Apple, since Tim Cook's death, they really haven't had a lot of new innovation. They're adding fringe benefits to existing technology. However, they do expect next month to introduce an enhancement to the Apple Watch that you will be able to send and receive text messages on your Apple Watch. I don't know if you can read them. You must have very good vision if you can read a text message on your watch face. But be that as it may, this competition is, as I mentioned earlier, is international, and no less so in China, where Alibaba, which is their version of Amazon, um, had a major advance as they released the news that they too were enhancing their AI services. But we look at China's technology leaders, obviously Alibaba, but it also includes Baidu and Tencent Holdings. They've poured significant amounts of money and resources into the race to acquire hardware and customers for their artificial intelligence expenditures. DeepSeek stands out with its open source approach, and that's designed to recruit the largest number of users quickly, and then they'll worry about how to monetize that user base. Analysts were expecting the Magnificent Seven to report a slowdown in earnings growth when quarterly results came in this week, and in a quarter's reporting period, sell-offs are kind of normal in a bull market, and they're usually ignored. But this weekend's news shifted the sentiment from risk on to risk off, ignoring corporate commitments to spend billions on AI, maybe because of such commitments. But it did create an anomaly. We haven't seen this in a couple of decades. So despite the fact that the S&P fell on Monday, there were 199 stocks more that rose more than those that fell. So that's considered positive breadth. Since 1996, we've only had 3 similar instances when we've had an anomaly of this sort, and they're highlighted here. 2 of them were in 1999 and the other one in April of 2000. All 3 of these precede the tech bubble collapse that occurred in 2001. And now we have a similar anomaly that occurred on the 27th of January as the month closed out. In hindsight, we could say that these 3 divergences were a warning of sorts that something wasn't right in the market, which, given the hype of the prior 3 years and the prospect of an internet where nobody needs a commercial building, it was hard to dissuade people that valuations were extended. It was hard to persuade people that valuations were extended and that caution should be taken. Are we possibly in that same situation? Might the 27th anomaly be a rare instance of another warning? We just have to wait and see. In the old days, you could carve out an information advantage as an investor. That's what Warren Buffett is known for doing. He and Charlie Munger have a reputation for being patient, deep seeking investors, running through all the footnotes and the financial statements, interviewing managers and business owners, financial people, taking tour of factory floors, talking to the workers. That's a deep dive into what would be a serious value investor. In the early days of investing, this goes way back into the early 1900s, and even so in the early 70s, if you had early access to a news wire or you had connections to the right databases, it would put you ahead of the game. But now, information's everywhere. Anyone can immediately access just about every detail that matters. You want to look at a financial statement during earnings period? I mean, the companies post them online. I mean, they're there if you want to do the work. As a result, markets respond more rapidly to new information than ever before. Now prices move fast. We've seen this lately, even in market sentiment. In early December, one key sentiment measure was bullish, and then it crashed to the November 23 low right there. In early December, 48% of all respondents from the American Association of Independent Investors, the AAII survey, they were bullish. That bullish percent was near the high end of the range in recent years, but in the weeks that followed, the bulls disappeared. Short positioning, which is a measure of how optimistic investors are with regard to the economy, it's an offset to other sentiment data that supports a more bearish tone. And what we see is that the bullishness was very high, and then it dropped significantly. The low current levels are a vulnerability for stocks in a scenario where negative news starts reversing the trend. It reduces the firepower that keeps the market going up, if you will, at least along the edges. It's a weakening that can develop into a wildfire, if you will. We've seen that in the news. In other words, There's something for everyone. If you want to be bullish, you can find the information to do so. If you're bearish, you can find the information to be so. It's frustrating as heck, but basically it's no different than any other data point or report that we get. The short interest refers to the total number of shares of an index or stock that have been sold short by investors, but not yet covered or closed out. So when an investor shorts a stock, they're betting its price will fall. How do you do that? Well, you borrow shares from your custodian and you sell them at the current price. You do this on margin. You have collateral. The broker says you have enough collateral. I'll loan you these shares. So you sell them on your investigation of the market data that this price must go lower. It has to fall for whatever reason you decide. Well, basically, you still buy low and sell high, but you just do it in reverse order. You sell first because you borrowed somebody else's shares, and you buy it later and you replace the loan. That works well as long as you're right on the bet. But if the underlying stock rises, the short seller loses money. When we look at this short interest, what we find is it doesn't matter whether we look at the major index or we break it down into an equal weighted index. Drilling down to the individual stock level actually yields roughly the same results. Declining short interest to successive record lows has provided a steady flow of support to U.S. equities. If people aren't selling the stocks, then what's left over are the buyers. And that's supported the market for the last couple of years, and it has suppressed volatility. So to see the market move as much as it did in the last weekend of January was a bit of a shock for many people who didn't realize you could have big wild swings like that. But January is an indicator. It is the January is an indication of general sentiment. There's actually two parts of it. One is the first week of January, which is considered to be an indication of bull or bear for the rest of the year. And we started this one with a bearish week in January, but by the end of the month, it turned positive. And I have that marked coming up. When it is positive, then the odds of finishing the year with a higher high continue to increase. If we have a positive January, then 86% of the time we have historically had a higher year-end result. That's referred to in many corners as seasonality. And Friday marked the end of January with the seasonal trend here for the January barometer on the upside, basically reversing our assumption about the first 5 days. And we see that in this chart. This is the first day of January. Here's the last day of January. And we had a high prior, new all-time high. We did that 3 times. We had a break of the all-time high on these 3 days. That's generally a positive sign. And then we get the sell-off from the DeepSeek, and rationale starts to set in. People begin to start looking at what was really announced. Can this really be true? Skepticism continues to rise, and the stock market continues its general bullish trend upward. The key support would be this black dotted line, which is the 50 daily moving average. Now, if you follow, we're talking about January effect. We also take a look just briefly for fun at the Chinese calendar, and this is the year of the snake. I don't normally keep track of these, but I ran across it. So what's interesting here is the year of the snake was also the year of the 1929 crash, the 2001 collapse of the tech bubble from the prior, at that point, prior 4 years. And here we are in 2025. Does it bode ill for what lies ahead? Well, one place you never find a bad forecast is on Wall Street, and there's no exception for this year. So we have forecasts for end of year ranging from a pessimistic 5.8% gain to an optimistic coming out of Wells Fargo of nearly 16%. That's averaging right in the historic average of a 10% return for the market. The interesting thing is that while all these forecasts go up, why did Bank of America choose the ominous 6666 number or Wells 7007 number? Is Wells Fargo playing the Price is Right with its number? It seems kind of silly. We do have should expect some choppiness in the market as normal, but probably more so because valuations are so high, and now there's a real question about the efficient use of capital with AI projects. But we have another problem, and that is what's going on in the bond market. Because in the January Fed meeting, the decision was don't make any changes. The assumption is that inflation will turn out to be transitory and continue its slow slippage back towards a 2% target. But what we have is the extension of the worst bear market in history, with rates coming down, but very, very slowly. And the dollar's weakening. That does offer some prospects for diversification with some better profit probabilities than we've had in recent years. The point of paying attention to bonds, particularly if you're using bonds as your risk mitigator, is it hasn't been working now for 4 years. You've been losing money in your bond portfolio. You have to remember that bonds are the value of your bonds are tightly correlated to interest rates. When interest rates rise, the value of your bonds falls. It's math, and you can't change that. It is not unlike the stock market where sentiment and belief enters into the price of a stock. That doesn't happen with bonds. It's either the interest rate that you can provide with your existing coupon, or you just don't have a transaction. When rates rise, bond values fall. When rates fall, bond values rise, which made bonds an effective risk mitigator from the 1980s until 4 years ago. The assumption that people are using and financial advisors are using to balance the risk in your portfolio is with a bond assumption that has fallen apart. When we look at the current yield on the 10-year Treasury bond, which is the global benchmark for where interest rates should be, we can recognize that the market advance has been based on lower rates plus the adoption of artificial intelligence. Investors have been driving Treasury yields lower and not waiting for the Fed, which was expected and did make no change in the final week of January. Yields are now at the lowest level this year, with the 10-year trading nearly 4.5%. Now, Trump's first week in office has not been as destabilizing as feared. And after a mild inflation report, bond traders were in for calm in the bond market. So we actually don't see the Fed changing interest rates probably anytime this year, because inflation is stickier than they had anticipated. Now, we do these summaries every month on the first weekend of the month. And if you want to know where we are at the end of February, go to our website, iriradio.com. register for the March stock market update webinar. When we do these, we take a look at where our portfolios were positioned in the prior month, and this is where we were at the end of January. We use technical analysis, and technical analysis is a study of market behavior and therefore market participants. What are market investors, participants, actually doing with their money? They may say one thing, but where they place their money is their vote of conviction. It's an examination of how humans behave through the simple actions of buying and selling. Price is the official arbiter of truth and represents the conclusion of all the value investors and all the growth investors, all the skeptics and all the optimists in the market. Price tells you what they decided. And this is where we were last month. And this is where we ended the month of January. Our select model has 20% allocations. The global model is 10% allocations. And the dynamic model can be anywhere from 0 to this month as much as 25%. All of our models have an option to go to all cash when everything is selling off. And what drives the decision on the allocation is where is the money flowing into the market, and is it driving that particular industry or sector to the top of the performance list. We're not in the prediction business. We are in the interpretation business. Markets are dynamic. What we do is not rocket science. Software today is readily available. Training is readily available. But this is not something you can do by sitting in your easy chair and going to sleep. If you want help, you should contact us. Somebody needs to worry, watch, and actually make a decision to do something. You can do this. You spend a little bit of money and an enormous amount of time, and as we were told, about 5 years of making big errors and getting things figured out on your own, then it's possible to do that. Or you hire somebody, and if you want to talk to us, we're available for you to talk to. Email us, help@IRI Radio, with your questions. If you want a second opinion on your portfolio, it's free. Let us know by contacting us. We're no survey here today. Subscribe to our YouTube channel. Follow us on follow Investor Resources on Facebook. Again, if you found this interesting, you probably have family, friends, and coworkers who would find it interesting also. We'd appreciate it. One, subscribe to our YouTube channel and pass on the link for your friends, family, and coworkers to watch it. With that, we want to thank you for your time with following through here today. And have a great day. Subscribe. We'll have more podcasts coming soon.